So we will reconvene now this panel with a new session, which is about the evidence from the private sector. And for that session, we're really pleased to have with us um, excellent experts from Deloitte, Felicia Gan, who is senior manager at Deloitte Singapore, and who even agreed to join us, you see, in person. And so we are really happy to have her with us. Then we will hear some other colleague from Deloitte in Europe, and then we will have perspective from a company, Fonterra, in New Zealand. But without further ado, we'd like to hear about your perspective, Felicia, in dealing with proof of origins from the practitioner's point of view. We will share your slides. You're on screen, so the floor is yours.
Thanks, Carmela. My name is Felicia Gunn, and I'm a senior manager from Deloitte Global Trade Advisory Practice. So thank you very much to ADB and Carmela for the invitation to join this event. I'm very delighted to be here this morning to share from a private sector the typical challenges faced by our clients in complying with the rules of origin and administrative requirements. So in the next 15 minutes, I will start with some feedback gathered from my colleagues in the Asia Pacific region on the typical challenges faced by their clients. And then I will go further to illustrate these practical challenges and concepts before moving on to discuss 3 case studies and closing with our final comments. So just sharing some of the hot topics and issues faced by clients, which includes denial of preferential claims when the operational certification procedures is not fully complied with. And it also earlier mentioned by Ha, the differing interpretation of OCPs, especially for complex supply chains involving third country invoicing and back-to-back arrangement. So in cases where companies are using regional distribution centers, they sometimes forego FTA benefits even though the goods qualify or are eligible for FTA preferential claims, purely because it is operationally difficult to track and trace the goods and also to match the materials or the goods after bulking to the original certificate of origin that the shipment comes in with. So there is also cases where there are more than one applicable rules of origin, but the exporter has found themselves not being given the choice to select the preferred origin criteria to be applied for their shipment. Instead, for this particular case, origin criteria is automatically assigned by the issuing authority in their approved cost analysis. So company actually have to go to the Ministry of Trade to appeal to use another origin criteria that they would prefer. I think one other point to note is that with the introduction of CAROTA, the Customs Administration of Rules of Origin under the Trade Agreement 2020 in India, importer in India has now added responsibility to conduct due diligence to make sure that the goods, when they claim preferential treatment for the imported goods, they have the right documentation and that the exporter is able to provide the supporting documentation. So this requirement does not make it any easier for businesses to utilize FTA. Moving on to the practical challenges, I'll start with third party and third country invoicing. So the diagram is a typical third country invoicing model where Indonesia exporter will sell goods to a Singapore trading company who will then on-sell to the final customer in Thailand. So goods will be drop shipped directly from the teller to the final customer in Thailand. So in the past, some customs authorities took a very literal interpretation of the word third party or third country. So allowing only 3 parties or 3 countries to be in this entire supply chain. So this has led to companies being denied of the preferential claims in the past, and in some cases they have the duties callback with penalties and interest. Right. So after much discussions and agreement at the ASEAN level, multiple trading parties and countries in an indirect invoicing arrangement is now being accepted. Another practical issues for using a third party or third country invoicing model is on the mentioning of the FOB value on the certificate of origin. So as Ha also mentioned just now, is whether this FOB value should be based on the first leg invoice, based on the manufacturer's FOB price, or based on the intermediary sales price on the second leg transaction. So due to commercial sensitivity, most companies will prefer to rely on the second sale invoice. However, customs authorities, some ASEAN customs authorities have challenged that you should actually be using the FOB price of the manufacturer. So this again leads to the rejection of COs. In the recent times, this issue has been partially negated. For FTA such as ATIGA or some ASEAN-based FTA like AKFTA and AANZ FTA, where FOB price is no longer a required field if the seller is not using RVC criteria. So that's negated for certain circumstances. However, this issue could continue to be a problem in other FTAs or when the RVC rule is being relied upon. So this is another scenario where the intermediate party is located in the same country as the final customer. So for example, the exporter is located in Indonesia, whereas the third party or the trading company and final customer is located both in Thailand. So from a Thailand perspective, this is considered as an indirect invoicing arrangement. This is certainly not a third country invoicing arrangement because there's only 2 countries that's involved. So if the shipment comes in under ATIGA Form D, the importer can still apply for the preferential claims without having to check or tick box 13 for third-party invoicing. Again, this position is not consistent across ASEAN countries. So for example, in Malaysia, a Form D with such a domestic invoice arrangement is actually not accepted. And unfortunately, this is an ongoing issue. This is a model on a back-to-back arrangement, which allows company to break bulk in an intermediate country and allows the re-exported goods to retain originating status. So in the diagram, goods that are shipped out of Thailand, where the shipment will be broken down into partial shipments in the Singapore Regional Distribution Center before it's being sent to respective ASEAN countries. For example, Vietnam. And then the intermediate party in Singapore can then use the original certificate of origin to apply for a back-to-back CO when it is exporting the partial shipment to, say, Vietnam. And this is possible as long as the quantity on the back-to-back CO does not exceed the quantity of the original CO. And of course, it has to be within the validity period of the original CO. So again, like I mentioned earlier, in such RDC arrangement, it is operationally difficult to monitor and track and trace, the quantities and tracking it back to the original CO. So sometimes businesses, they'll have to forego claiming the preferential treatment for such shipments. Right. Another type of challenge that we see usually with back-to-back arrangement is on the interpretation of whether or not the goods need to be under customs supervision or customs control in the intermediate country where they are going through break bulk or repacking activities. So again, there is no consistency in the ASEAN FTAs. For example, in ASEAN China and ASEAN India FTA, there is a specific provisions, express requirement for the goods to be bonded. Whereas for ATIGA and for ASEAN Korea FTA, these are silent. And A more recent issue relating to B2B scenario is where like Thai originating goods is shipped to Singapore for the regional distribution center storage, and then subsequently, yeah, they are unable to sell it, or for some reasons they have to return it back to the Thai exporter. A back-to-back CO that is issued by the Singapore Customs is actually not accepted by Thai Customs, although yeah, these goods originate from Thailand and it still meets the criteria. Yeah, so in this slide, I just want to highlight that other than third country invoicing and back-to-back CO, putting this both together in a very complex supply chain model, yeah, this is also another issue. So there is no one approach taken by ASEAN authorities, and we will discuss this further in case study 1. So let's move on to case study 1. Right, so in this model, company X is the RHQ in Singapore and is also the invoicing entity. Physical goods are shipped from overseas manufacturer, so in Japan, Thailand, Indonesia, China, to a warehouse located in a free zone in Malaysia, before finally importing into the other ASEAN markets, Philippines, Indonesia, Vietnam, Thailand, and Malaysia. So there's 3 issues that arise. One is whether a back-to-back CO in combination with a third country invoicing model, where box 13 you have both B2B and TCI checked, whether this will be accepted by the ASEAN member states. Yeah. So for this particular case, based on our research and discussion with the customs authorities, we found that Indonesia and Philippines is likely to accept such a combination approach. For Thailand, they will accept it only for ATIGA and not for other ASEAN Plus FTAs. And in Malaysia and in Vietnam, yeah, this is may not be accepted. So there is no clear guidance provided by the ASEAN customs authorities, and there's no single approach to such arrangement. Yeah, so the second issue that arises is, for entries back into Malaysia. So for Malaysia, so to the earlier example that I give, Thai originating goods coming to Singapore and going back to Thailand, yeah, and back-to-back CO from Singapore is rejected. So again, same question here. If it's a Malaysia originating goods, yeah, it goes into the free zone in Malaysia, RDC, and then comes back into Malaysia. Can a back-to-back CO be issued, and can that be accepted? From what we understand, as of now, the position is no, because yeah, there is no third or second country involved. Because it is still in Malaysia, it's just between principal customs area and the free zone, and then back to the principal customs area. Although in principle, the goods is still made in Malaysian originating. Right, so and we extrapolate this question to the third issue. In the case of the goods are originating from other countries, and it is the same country as the RDC. Yeah, what is the treatment for this? Can a back-to-back CO be accepted? Okay, moving on to the second case study. This is a auto manufacturer, which is using both locally sourced components as well as imported components. So for imported components, it's rather clear-cut, where there is a valid certificate of origin, yeah, whether it meets RBC 40%, or where it's a partial accumulation, so anything that's above 25%, RBC 25%, but less than 40%, those content can be accumulated in the RBC calculation. Yeah. However, for domestic components, where a local supplier declaration is requested to confirm that the goods are of the relevant countries of production, and to have that stated in the invoice, the issue arises particularly on this for ATIGA is Article 29, 5 of the agreement, which states that locally produced materials, locally procured materials produced by established licensed manufacturers in compliance with domestic regulations are deemed to have fulfilled origin requirement of the agreement. Yeah. However, for example, in Malaysia, there is no domestic regulations to clarify this definition. What is a licensed manufacturer? So this position is not clear, right? Does the intermediate goods still need to qualify based on the rules of origin, or does it mean that as long as you purchase it from a local component supplier, you can accumulate the origin content? So what we gathered is that in Malaysia, for intermediate goods purchased from supplier with a valid CO or a valid CO with partial accumulation check, it can be included in the RVC calculation of the finished product. But for the accumulation of locally purchased goods, there is no published guideline to date. So this is still open for discussion. Okay, moving on to the third and the last case study. This is a case where the manufacturer and exporter is in Singapore, who will then sell goods and ship the goods directly to a related party in Korea. So the importer in Korea has been claiming preferential duties for under both Korea-Singapore FTA and ASEAN-Korean FTA. So what happened is that Korean Customs Services noted some irregularities in the certificate of origins, various issues, right? Omissions of origin criteria on the form, or missing HS codes, or like commingled origin criteria marking for the same type of products. So this has raised some questions and reasonable doubt to the validity and the origin information contained on the CO. So what they did is the Korean Customs Services requested Singapore Customs to conduct a verification on the authenticity and accuracy of the certificate of origin, and set a requirement for Singapore Customs to respond to their questionnaire within a specific time period. So if the responding customs authority did not respond within the stipulated time period, then they will deny the preferential claim. So that's also one problem that businesses face, is that they have to get the authorities to respond to such query. Yeah, and sometimes it's beyond their control, right? So fortunately, in this case, Singapore Customs is rather facilitative and responsive, which they did respond within the 30 days period. So on the next slide, just wanted to share, under just an example on the provisions of origin verification under the FTA. So we have similar language in both ASEAN Korean FTA and Korean Singapore FTA. So I'm just going to give one example. So the FTA actually allows the importing country authority to conduct a verification wherever there is reasonable doubt to the authenticity of the rules of the certificate of origin, and they may request, in a sequential manner for verification from the importer, or request for costing information from the importer, and so under A and B, this normally not sufficient, and importer unlikely have the costing information. So what they can do is that they will request for the cost information from the exporter or the manufacturer in the country of production, through the customs administration, in this case Singapore Customs. And if they are still not satisfied with the documentation received, they can visit the premises of the producer, and this is what happened in this case. And it's not an isolated case. We are aware that prior to the COVID pandemic period, Korea Customs has been really active with origin verifications. They practically come to Singapore every year for such exercise. Um, yeah, and in this particular case, Korea Customs come to Singapore for a period of 1 week, sit down at the manufacturer's plant to really look at each step of the production cycle and gathering source information from company's ERP system. So when they are here, so the things they look at is obviously whether the first of all, is there substantial transformation, or is there like only simple mixing and assembly? So that's the first criteria. Because this particular case that is more of animal feed production. So they actually buy premix and then they will mix it together. So that the first question that Korea Customs asks is this just simple mixing, or does it fulfill the substantial transformation test? Right. And then they will also look at the RVC value. So again, because throughout the years, there may be some changes or fluctuation to the selling price of the product, which affect the regional value content determination. And the sourcing of materials can come from different countries. So Korea Customs really just want to validate that the goods continue to meet the rules of origin criteria. In this case, it's a RVC of 55%. It is a product-specific rule. Another issue is that they realized that the cost statement that's been submitted for the certificate origin issuance actually doesn't correspond to the invoices that the company presented as supporting documents. Because of this use of standard cost versus actual cost, right? Because they allocate the cost. So it's a bit difficult for the company to trace back to the exact actual shipment for the particular material or batch of material. They also question on the format of the certificate of origin, right? Such as the origin criteria marking, whether it follows closely to the overleaf notes. And in cases where sometimes the HS code is not indicated or is not consistent, they have also raised this question. So as an outcome for this investigation, they found that there are some products that is inconsistent and they did not qualify under the ASEAN Korea FTA and Korea Singapore FTA rules of origin, and therefore resulted in the denial of preferential claim, and additional bail of demand, and with penalties and interest for some of the items. Okay, so next slide. We have come to the end of the case studies, and this brings us to the last point. We all know that preferential trade agreement is an exception to the WTO MFN rule, and it have allowed country to negotiate rules and commitment that go beyond the WTO level. So with so much inconsistency in terms of the interpretation and application of the origin criteria, we need to consider what is the way forward for trade facilitation. How do we converge the rules of origin to make it easier for businesses to start utilizing FTAs and facilitating trade in general. Okay, with that, I hand it back to you, Pramila.
Thank you so much, Felicia, for this excellent presentation, all these case studies. I think it was very concrete. I mean, it brought us straight to the point, and we're really happy that you shared this with us. Now we are going to hear your colleague, Pier Paolo Ghetti, who is also working at Deloitte, but he's based in Europe. So Pier Paolo, thank you so much for joining in the middle of the night. And we're really grateful for you to participate to this event, and we really look forward to your presentation.
Thank you, Pramila. Thank you all. Thank you for inviting me to the event. I hope you can see the presentation and you can hear me.
Yes, we can see
okay.
The presentation. We can hear you.
Good. So my view is that, and I will keep this presentation short and brief as possible. My view is that proving origin is the final component, is the final leg of a wider process because proving origin means that the firm has implemented an internal process which is quite cross-functional, meaning that it involves different functions. For example, the purchasing for collecting information from suppliers, production and research and development for calculating origin on the bill of materials, logistics and customer service for the outbound. So and this is only the internal stakeholders. Then you have the external stakeholders like suppliers, customs authorities, customs brokers, freight forwarders, and this gives you an idea of how complex a management system for rules of origin and trade preference is. So I would say that proving origin is the tip of the iceberg, but then behind that we have much more. And what I see every day when I talk to people in companies is that the condition to implement these processes is that they can be automated and standardized. So every phase of the process needs to be standardized and automated. And every time a process is manual or not standard, this of course makes the trade preference and more in general the agreement less attractive. So for example, having an original signature on a certificate of origin or on an export declaration or a statement on origin, or having paper-based supplier declaration, these kind of things. And to me, this is very important. So we need to look at the things from the company perspective and see and try to think on the main challenges for the company. To me, the main challenge is what cannot be automated and standardized. In this slide, you see that the process starts from sourcing raw materials, components, and sourcing can be domestic or an importation, non-domestic sourcing. And there we have the collection of origin data from a supplier. Then we move to the processing phase. So when we process the goods, and here we have the rule of origin application and calculation of origin based on the combination of materials used in our product. And then the final piece, the final component, is the distribution and the origin certification and verification. So I think we need to have an holistic view of this. And for example, if you look at supplier declaration and origin certificates, those two elements are interlinked, as I need to collect the appropriate information from suppliers based on the certificate, on the nature of the certificate of origin I will need to release upon export. So dealing with multiple agreements and multiple certificates of origin generates complexity not only upon export, but in the whole chain of events. Some points of attention. First group of things is data collection, so collecting data from different stakeholders. In particular, the automation in the data collection phase from suppliers is considered as very important by the private sector. And I would say that trade agreements and also the soft laws, so the guidelines of the trade agreements, but also the domestic legislation should allow for the most, let's say, agile form to collect data from suppliers. To give an example, the use of a company portal where the supplier input the data, the origin data of the products, is maybe something that should be allowed. as it is common practice to share data in this way in the business. Then second element in data collection, for cumulation and accumulation, and evidence from suppliers. In this case, sometimes we see that there is form over substance, meaning that sometimes when I use imported materials and importing those materials, I use a specific certificate of origin, then these products cannot qualify as originating input materials for other FTAs. Of course, this is a big limitation in the potential of the accumulation, and more in general in the regional integration. No? So I would say that an option is to maybe also in this case maybe make it more agile or more and extend the possibility of using a certificate of origin for accumulation of input materials. Then moving to the application for origin certificates, so when the exporter applies and requests a certificate of origin, we have an issue with the latency between the application and the issuance of certificate of origin. We have discussed before the e-certification, which is very good, which is very business friendly, no? But what we see in practice, the empirical evidence, I would say, is that in some sectors, for example, the fast-moving consumer goods sector, transit time is crucial, and it's even more important that than the saving on the import duties. So reducing to the bare minimum the latency between applying for a certificate and obtaining the certificate would be key, and maybe allow for a swift release of the certificate unless there is a reasonable doubt on the origin declared by the exporter. Second element on the application, based also on some interviews also in Asia, it is not always clear and not consistent in time the nature of the documents that need to be presented to obtain a certificate of origin. So this makes the process less predictable, less certain, and it would be important to have a sort of common standard in the set of documents that need to be presented. Again, for the same reason I was describing at the beginning, so having a standardized procedure is key. Last elements are the certification, of course. So proving origin with an origin certificate or a self-certification, a statement on origin. I mean, it's clear that self-certification is a more business-friendly solution, but there are situations where the certificate of origin can be a good solution as well. For example, if you look at multi-tiered transactions, when the invoice issued upon export is not the same invoice used for import purpose, then in those situations, maybe a certificate of origin is more straightforward. It's easier and more manageable from a customer's perspective, rather than a statement on an invoice, which is not the same that is used for import purpose. So in my view, but we will obtain a feedback from the companies in the area, is that a combination of self-certification and certificate of origin is maybe, let's say, the optimal solution to allow a flexibility and flexible approach for the exporters. Other, let's say, minor elements: retrospective declaration of preferential origin for multiple import shipments. So what happens when I have exported multiple shipments and then I need to, I'm asked to provide a retrospective declaration. We view that it would be very good to have the possibility to release one consolidated origin statement instead of multiple origin statements. So consolidation would be a good simplification. Think about, for example, situation when you have a bonded warehouse in the middle, so multiple shipments that go to the bonded warehouse, then you have a single withdrawal of the goods from the warehouse. Very last point, certification waiver. Of course, it would be very welcome to have an increase of the threshold for low value goods, low value shipments that do not require an origin certification. And there's no need to explain why this would help the business. So these are just some elements to foster the discussion, but of course every organization has its peculiarities and its business needs, and these needs of course need to be balanced with the necessity to counter non-legitimate origin claims. So I completely understand the need for controls and also sometimes formal or formalistic approach. So that's it from my side. I hope I gave some insights from the private sector perspective, and happy to move on with the discussion in the Q&A session.
Thank you so much, Paolo. Thank you for this insightful presentation. I think you really clearly indicated, or different challenges, and also give us some hints on where to look at, what would be, the best practices or the most lenient or the most, let's say, business-friendly rules. And we will move directly to the next speaker and the final speaker, who is actually a representative of Fonterra, a company based in New Zealand, and he will share the daily challenges and complexity in facing the different agreements and different rules. So we have Kit Hickey. Are you there?
Yes, I am here. Hey, thanks for your time and patience on this. And I'd like to thank the Asian Development Bank for the opportunity to present to you on our experiences with trade agreements. Listening to the earlier presenters is really interesting, and it brings home to me the importance. So anyway, the sharing of experiences between business and government is useful because it helps us understand areas that work well as those that don't. Oh, here we go. And to understand why. The why is important because this increases the chances that the implementation and operation of future trade agreements will be less challenging than they have been to date, thereby reducing time and resource imposts for both customs and business. The sharing of experience also helps us understand each other's capabilities and limitations, which will provide negotiators with better tools to effect more realistic outcomes. This presentation reflects my experiences as a customs auditor, a trade negotiator, and implementer, as well as Fonterra's experiences with such agreements. Few would argue about the potential of trade agreements, and although trade facilitation is often associated with them, the reality is quite the opposite. Trade agreements come with extra rules and requirements that add complexity, cost, and risk to the trading environment, and these need to be managed, sometimes to the point where the advantages of a trade agreement are outweighed by the cost and risk, and you don't bother. While the ambition of trade agreements is reflected in the market access outcomes, this is not necessarily so with the operational certification procedures, the OCP. And although these procedures have an important role to play, more often than not, as practice, they actually work contra to the policy ambition being negotiated. This is very noticeable with plurilateral type agreements or agreements negotiated by blocks of countries, for example, anything that involves ASEAN, as the outcome on certification is often, in fact, generally the position of the least ambitious member. The actual rules of origin as they are negotiated and intended provide clear instructions about the level of transformation required for goods to be deemed originating. Origin is a where word, and where the substantial transformation takes place should be the defining factor. The paperwork, i.e. the OCP, is incidental to this other than being a useful tool source of information to carry out an initial check of the goods being entered. Unfortunately, somewhere along the way, the OCP has taken on a life all of its own, and the paperwork, rather than the goods, has become the key determiner of whether the goods are originating or not. In my experience, there are several problems with this. Legitimately originating goods are being rejected because the paperwork is or is considered to be inadequate in some way. This can be as spurious as a stamp being the wrong color, the font size is wrong, or the certificate of origin borders don't look right. Nothing to do with the goods. OCP text is often poorly crafted and open to interpretive misunderstandings. For example, the context. The OCP can silently flip-flop between export certification verification, COO issuance procedures, and import clearance verification procedures. These get mixed up in the negotiations, and the delineation between the two is often not made clear in the text. Negotiating parties can come to the table with differing views on what they are negotiating, and this may only be appreciated late in the negotiations or worse, after the fact. Poor understanding of global trade processes and documentation resulting in impractical and unworkable documentary requirements, and more on that a little bit. And definitions, possibly the most important thing. Critical elements of the OCP are not defined. Negotiators may agree to something, but unknowingly have a different understanding to what they have agreed to. For example, third-party invoicing. And simple linguistic differences, such as the word from, the date of issue, or third party stroke fourth party stroke fifth party. The number of negotiations I've been in when we're talking, it's an English colloquialism. A third party is anybody other than the parties. But of course, once you get into fourth and fifth invoicing, suddenly it goes all wrong. Customs is very familiar with imports, which are invoiced from a place other than the country the goods were exported from. This is a normal commercial practice with trading houses and multinational companies and makes up a high percentage of global trade. However, when a trade agreement is involved, this business as usual practice suddenly becomes worthy of special attention. The genesis of this mindset is historical and comes from the idea that a non-party should not benefit from a trade agreement, and the third-party country provision is a way to deal with this. Time has moved on, and over the last 20 to 30 years, business models have evolved, and in many sales, a large part of the value may be a payment to a person in another country. A royalty is a good example. Or that the sale price after export somehow affects the value of the imports during the manufacturing process, which of course is absurd. In terms of determining the origin of goods, the seller's location or the money flow should not be relevant to this, and it's time to accept this provision is more trouble than it's worth. It also doesn't help that sales invoiced this way are poorly defined in agreement text. Sometimes it's called third country invoicing, or third party big P invoicing, or third party little p invoicing, and is a source of ongoing and unnecessary conflict simply due to the lack of consistent definition of what it is. Any entity or practice allowed in a trade agreement must be clearly defined for the agreement to function correctly. It belongs in or in alignment with the general definitions chapter. Doing so would also bring consistency across agreements because the parties are invariably defined the same in all agreements. The 3 points in this slide reflect third-party interpretations across the Asia-Pacific region. In fact, they're part of ASEAN, ANSFTA. One aligns with the definitions for a party and is therefore sympathetic to and consistent with the broader agreement. It is simple and consistent. The second one results in two definitions of a party. One is a country, a party, and the other is a commercial entity, regardless of geographical location, and is probably the main source of conflict with third-party invoicing, especially when a certificate of origin issuers in the exporting country and a certificate of origin verifier in the importing country disagree on which definition is correct. And 3 is indicative of a lack of harmonization between agreements, largely due to poor definitions or no definitions for a common and recognized business practice. It is also worth noting that importers may have no visibility over export invoices and may not be able to provide any details if asked. Another indirect consignment is another issue that seems to cause a lot of heartache. Documentary evidence that the goods have not been tampered with or further worked when consigned through a non-party is common to all agreements. A certificate of non-manipulation is the traditional document for this. Not all countries issue these certificates. In this example, if there is no direct vessel between New Zealand and China, the goods will need to be transshipped. Ex-New Zealand, you've only got to look on the map. The most efficient routes are via Australia, Malaysia, or Singapore. Neither Australia or Malaysia issue these certificates, which means that supply chain efficiency and flexibility is reduced. More recently, through bills of lading are seen by customs as useful for origin verification purposes, with the expectation that all transit ports will be shown. This is generally not the case, and should the bill of lading not show the intermediate stops, customs can and does deem this document as presented to be insufficient for origin purposes. Bills of lading are also inappropriate because they are issued by entities that are not subject to the rules of trade agreements and are also beyond the control of exporters and importers to influence. Carriers are under no obligation to show a breakout of a voyage on the document, and nor should they be, as the contract of carriage is to provide a service between point A and point B. Any points in between are not relevant to this. There's also potential changes in how carriers operate, such as the move to bigger vessels and a corresponding bypassing of smaller ports, which may further reduce shipping options. What this means for indirect documentation should be high on somebody's list for discussion. If I were customs and looking for assurance about the nature of the goods, I would look to the export entry in the country of export for several reasons. It is a legal declaration by the exporter. To one degree or another, it will have been verified by the exporting customs. And if there is an AEO MRA type connection, the container seal numbers are very specific. And with a trade agreement, there will be formal roles and responsibilities between exporting and importing customs. Entities at transshipment points, customs or otherwise, are under no such obligation. This is also reflected in the review of the RKC specific Annex K, where there is increasing support for direct consignment rules that focus on the goods rather than the means and route of transport. Discrepancies. These cause a lot of problem. What is a discrepancy? Most trade agreements allow for small discrepancies or errors in the paperwork that shouldn't negatively impact the originating status of the goods. However, it's not always so simple, and in many instances, unless a discrepancy or error has previously been recognized and agreed to by the parties, it will not be treated as such. A good example is ASEAN's list of decisions and discrepancies, which in theory is a living record of discrepancies and how they have been resolved, but has become a definitive list of acceptable discrepancies, meaning that anything not on the list is not acceptable. Two common discrepancies that cause problems are HS interpretation. Differences in how the HS is interpreted is more common than people realize. FTA COO generally require the HS code of the goods to be shown. Many trade agreements place this responsibility on the issuing body in the country of export. They, of course, will use the HS code they deem appropriate. The importing customs requires the import entry to show the correct tariff code, which will be the code they deem appropriate. When the code on the COO differs from the code used for the entry, it is treated as a discrepancy. There are practical solutions to this. For example, the COO allows for 2 HS codes, or the COO issuer accepts classification rulings from the importing country, but these solutions are not always allowable by one or the other. Date alignments between documents. Dates printed on documents are important and must accurately reflect the facts. This is important for customs, but also for banks, insurers, carriers, etc. Normal supply chain activities can be misunderstood and treated as a discrepancy or error by customs. A good example being the shipped on board date versus the date of shipment or date of export. The shipped on board date is the date the goods are loaded on the vessel. And is the date shown on a bill of lading? It is a key date for insurance and risk purposes. Certificates of origin generally show the date of shipment or the date of export. That's the date the goods are actually exported. Two different activities. The shipping the goods on board and the date they are shipped often happens on different dates, usually due to an evening load out and vessel departure and the following morning. So you have an automatic discrepancy here. Having preferential entry denied for such a reason indicates a need to upskill negotiators, define things better, and clarify supply chain operations and terminology. So there are options, and many of these options have been discussed today. And of course, below this, there are e-certs and data transfer as well, but these are the traditional ones. So having a single entity review all certificates of origin applications for all exporters, all industry sectors and products has significant resource implications. So government and authorized bodies have limited resource. I would argue that it is not possible to ensure that 100% of the data submitted is correct. This means verifying applications has to be done using risk management principles. No one can look in depth at all of the applications. In effect, the importing customs is outsourcing its revenue risk assessment to somebody in another jurisdiction and to someone who may define risk differently or have a different tolerance to risk. Most certainly, the importing customs can verify these certificates, but experience tells us that preference is generally accepted based on the appearance and familiarity of the certificate as provided from the exporting country. If you can achieve this, the goods will not be looked at or questioned. Self-certified certificates, they seem to be becoming a little bit more popular, but they sit in a funny middle ground. For many customs, they provide a separate document which makes them familiar, but for exporters, these certificates largely duplicate data already contained within other documents handed over to customs for import purposes. If they are to be used, my advice to traders should be to make them look as familiar as possible. Make them look like an AA, NZA, FTA certificate of origin or an ATIGA certificate of origin, as the format will be familiar and there will be less problems. The real advantage to self-issued certificates of origin is there are no third-party costs. In New Zealand, the average cost of an officially issued certificate of origin is about $25 US. If it is in hard copy, that needs to be couriered. This adds 10 to 20 US dollars. And there is often a $10 to $20 in surcharges. Look at an average for our company of 24,000 certificates of origin per year. It adds up quite quickly and exceeds $1 million. Invoice declarations. Extra documents like certificates of origin create the opportunity for additional scrutiny and misunderstandings. The less documents, the better. Our experience with origin declarations on invoices is they work well most of the time, although third-party invoicing complicates things somewhat, as the export and import invoices will be different documents provided by different people. The best document for an origin statement is the packing list because it is provided by the person who stuffed the container, is not linked to a changeable document like an invoice, and is an essential part of a commercial document set. Something negotiators need to be made aware of is the potential technical and financial impacts that added data or the location on a document may have on transactional systems. Some of the earlier speakers talked about what business would see as the most effective and preferable method of applying for origin, and it's just simply using the customs import entry. So certificates and declarations serve no purpose really, and they do generate conflict, inefficiency, and add cost to cross-border trade. The customs import declaration is where the focus of verification should be. It is a legal commitment by an importer that the information they are submitting is correct and lawful. They are submitted by a person who has beneficial interest in the goods, and the person completing the declaration is also within arm's reach and can be materially sanctioned if they state anything untoward. From a customs resource point of view, prove it or lose it is the most efficient form of verification. Simply tell the importer they have 20 working days to provide sufficient evidence that the goods are originating, at which time full duty rates will be applied. It also is covered by existing legislation and powers, so there is no change to what customs are familiar with. There's no need for upfront documentation or expensive data transfer processes that may or may not be accurate, nor is convergence an issue. There's nothing to converge. Do this and a lot of the conflict related to these certificates will go away and revenue assurance will increase. Post-entry audits. These are of high interest because, as somebody mentioned a little bit earlier, I think it was a colleague from Deloitte, customs audit activity has increased significantly since COVID. Governments are looking for revenue, and post-entry audits, in our experience, are now increasingly focused on FTA compliance. So where customs risk is generally a single risk per a single entry, as each entry is a declaration in its own right. With post-entry audits, you get cumulative risk, you get large assessments. They take time and resource for both customs and for the trading sector to deal with. And along the way, we've noticed that penalties have become core revenue as well, which also makes these audits quite dangerous. And from a customs point of view, the goods have long gone anyway, which of course is an inherent downside with post-entry audits. The idea behind post-entry audits is very good, and I support it, that the goods should be moving, and then verification can happen at leisure. But just be warned for other traders that post-entry audits, if you are going to be exposed to them, and I recommend that you are on very steady ground around what your customs expectations are, how your customs defines certain things like third-party invoices to avoid a large assessment. This is my presentation for today, and I thank you for your time and welcome any questions you may have. Thank you.
Thank you very much, Kit, for this excellent presentation. I think this session with the private sector views is very insightful for all of us, because I think you know, it's much better than just discuss among just international experts and government officials. It brings new insights. Unfortunately, we are really running out of time, but if there is one pressing question in the room, I will take it. But otherwise, I think we will have to close. But there is one question in the Q&A chat box, which is about, is the certification for non-manipulation useful to the back-to-back PCO application? You want to enter? Okay, you want, if you want. So you have one answer, and then we will close.
Actually, for the non-manipulation certificate, it depends on customs authority required. But indeed, it's some customs authority, they request this one for the back-to-back shipment, because they need to the shipment need to be approved that there's no manufacturing activities interfere, or the goods interfere during the shipment and store in the intermediate country. So it depends on custom practice of the country. Like I experienced this when ASEAN exports the goods to China, and when our goods go via Hong Kong port, and China and Hong Kong different party and not in the Form E. That's why Chinese custom, they request for the non-manipulation certificate, and it creates some $100 per shipment for Hong Kong customs to issue that certificate. That's why during the negotiation, we requested China to remove it, but they still has hesitant to remove that, because China's could come to ASEAN, we don't require it for that kind of certificate. So it depends on the practice.
Okay.
Yep. Do you want me to answer the question on ASEP before?
No, you can have bilateral discussions, but I think, unfortunately, I'm really sorry, but we don't have time. But first of all, I would like to thank all our speakers and the attendants, all the audience for being here. The presentation, they will be all on our event webpage. So feel free to browse them, because in some of them you will see also you have reference to literature on the areas at the end that can be useful. And you should have also the contact details, or if you don't, you can also reach out to to me, to my colleagues, if you would like to talk. I'm sure that Kit, who made the next, and Pier Paolo and all our colleagues also from the private sector, they are really, I'm sure they are available, Felicia, to answer, to discuss with you. But as the time is too short, we will end this session now, but it's not the end of the discussion on the proof of origin. So thanks a lot, and I wish you a very successful or nice end of APTFF 2022. Thank you very much.